spin.
Great. This is great to be here. I'm excited about this panel because at Coinbase, I'm on the institutional sales team, and my responsibility for the last 2 years has really been on ETF issuers. But 4 months ago, I was handed the miner book to manage. And so the questions that I've come up with are all the questions I want to ask to understand Treasury management. So whether you all want to hear it or not, I want to know the answers to these questions. So excited to be here, excited to have a great panel. I'm going to let each of my panelists introduce themselves, and then we'll take it from there. So Tyler.
Hi, I'm Tyler Page. I'm the CEO and founder of Cipher Mining.
Hi, Ari Pine of BlockFills.
Hi, Danny Goodman with Core Scientific.
And I'm Chris Bay, CEO and founder of Enhanced Digital Group.
Great, thanks guys. I was, just as an aside, I was at the Cantor Fitzgerald conference in Miami last week, and I got the opportunity to hear Michael Saylor speak. And he said the only thing better than Bitcoin to own is levered Bitcoin. So it's interesting to talk about a group of miners that obviously are stacking coins, but also selling the coins. It's kind of an interesting situation where you have the greatest appreciated asset over the last 10 years that you all are mining, and yet you have to dispose of it to pay your operating costs. So that's sort of the conundrum that you're all faced with. So when I look at that and I think about that, one of the first question I have is for Chris. When you think about sort of traditional S&P 500 type companies, how is Bitcoin mining treasury management different from your typical Exxon or Mobil or Apple?
Oh, that's a great question that maybe Tyler would be best to answer. But I think what's really hard is there hasn't really been a proof of concept. The industry is evolving at rapid pace, and I think it's probably one of the hardest, most interesting problems out there when I interface with mining companies. I mean, I think managing treasury is a multivariate problem, but I think Bitcoin mining is a multivariate problem. And so when we approach it and we think about and we learn from clients, wow, you have all sorts of input hedging costs, whether it's energy and machines, and then the output is incredibly fascinating, obviously, but in it itself has a volatility of 80. So between input and output hedging, there's so many different dynamics as it relates to it, whereas in more traditional Fortune 100 companies, there's proven process and protocols that have stood the test of time that we don't have the answers to yet because every miner is going about it differently. And that's certainly our approach is, I don't think this is one size fit all. I mean, this is a really hard industry. Every particular corporate is so different in their acumen, their specialization of how they extract Bitcoin. And so we just really try to listen and meet the clients where they're are and see where we can learn, and hopefully everyone can sleep well at night.
Great. Tyler, do you want to add?
I mean, I'd just say from my seat, this is an evolving question about how to do that. So we've been public now coming up on 4 years, 3.5, 4 years. And I'd say when we went public in 2021, this is always a popular discussion, on road shows and how do you think about this, because there is some differentiation among the different companies. 3 years ago, these were public equity proxies to get exposure if you could only trade equities. And so there was some value put on owning them from like a stock valuation perspective. Independent of that, all the companies have different sort of philosophies around Bitcoin. Some people are quasi-religious about it and don't ever want to sell it and think it's going to $10 million in 2 years or whatever. And I hope that happens. We're definitely Bitcoin bulls, but we manage a public company to maximize the dollar-based return for shareholders. The way we've ended up doing that is striking a bit of a balance between we do run a Bitcoin treasury. It's probably up, over the last couple of days, but call it about $100 million right now. We will sell it though if we see something better to buy, and we think about hedging. We hedge around known events. We've got things like elections and halvings and ETF approval deadlines and things like that, and so we at least try to do a more primitive version maybe of the Exxon Mobils of thinking about, you produce a bunch of oil you sell some right away, you put some in the terminal, you sell some futures against other pieces, and think about capital planning and hedging. And we try to do that, and hedging's gotten better, but this is an evolving question. I think, at least from my seat, probably the value you get from just holding a Bitcoin Treasury, stock reaction may be different than it was a couple of years ago. So it always moves around.
Great, interesting. So you said the word bull market. Do you think differently in a bull market than a bear market, and how so in terms of treasury management?
There is a portfolio management element to this. So we have a very thoughtful team of traders and quants. We take portfolio management very seriously. We probably have a bit of more of a Wall Street pedigree at our firm compared to some of our competitors. Many of us spent lots of years on trading floors. So yeah, there is an element of a call. I think it's a dynamic question, which is to say, you're thinking about the value of your treasury, you're thinking about your sort of capital spending that's coming up in the near term, and how do you balance those two things? So of course we're predisposed around, we always have a view on Bitcoin. That's gonna change what we might do. And we are pretty bullish right now. Typically, we will take some amount of Bitcoin we produce on any given day and sell some of it for dollars. And that's because to make those Bitcoin, we have incurred a dollar-based liability in the form of a power bill that day. And so generally, not always, but generally, we will not sort of speculate over the 3 weeks until we get our power bill as to what happened, and we have really low power costs on a relative basis, and so some amount of our Bitcoin we typically turn to dollars to effectively hold against that obligation. What we do with the rest then is the question, and it does change from bull market to bear market.
Ari, when you think about that in terms of talking to your customers, thinking bull bear, are there different strategies obviously that you're going to talk about, and the comfort level of the customer?
Yeah, I mean, absolutely. Everybody's going to see the market differently, and as Tyler pointed out, each miner is going to have different goals in terms of, do they want to be viewed as a holder of coin, or do they want to be a business that's focused on producing Bitcoins efficiently, and where on the spectrum of that would they like to be? And then I think also it really depends on what the market is giving you. Bull and bear markets can, my background is on the trading side, so I'm not necessarily going to be the person that's going to take a look at the efficiency of your rigs or something like that. But where I can help you out is evaluating the market and saying, hey, that's a good price, or that's a good opportunity, and being able to capitalize on that. And that does tend to change between bull and bear markets.
You mind if I add just a couple details? So for, I guess, the question that we're currently on, do you have like a different view coming from the miner in a bull or bear market? Yes, you should. You should act differently in different environments, or you are very wrong. But just to revisit the first question real quick, as far as, and just want to highlight a couple of the differences between like a traditional company that I think is easily missed. So you mentioned Apple with iPhones. They have a certain amount of pricing power as far as what they charge for that individual iPhone. There's a supply-demand dynamic that they can very heavily influence. It's also even true for upstream oil and gas. A little bit more visibility into their supply. The big difference here as a Bitcoin miner is you really don't have that kind of pricing power. This is an asset that just pops right on the balance sheet, that is liquid, it marks to market. So it absolutely has to be managed, and very much as we're talking here, there are some environments it might make some sense to sell. And the other big difference when we're talking top line here, there's a number of moving pieces that other businesses are not going to see. So for instance, right now, Bitcoin is on a nice little tear. Let's call it up like 25% or so. Difficulty, on the other hand, so rough proxy for how much it's going to cost you to mine that, does tend to track price. There's a little bit of a delay, 2 weeks, but last I checked, I think block time is 8.5 minutes. You can expect a pretty substantial increase in difficulty. So yes, price did go up, but your overall margins may not have actually changed too much if you fast forward in a month. In a bad scenario, you get a retracement after that increase in difficulty, and you can really see your margins compress. So, like prudent financial management, risk management with that asset on the balance sheet, that is where how you realize revenue is critical. So,
Thanks. So in traditional, for TradFi and S&P 500 companies, like they can always, their counterparty is going to be a AAA, overnight repo or something like that. And for miners, obviously, you're not going to have those counterparties necessarily. So how do you think about counterparty risk and assessing that and returns and things like that?
Yeah. So look, if you're talking like Bitcoin native, there is no risk-free rate. So as far as I guess lending directly, I would highly encourage proper due diligence. Everything else, you will lose control over it. Maybe you have like a tri-party agreement. I would also mention, with that direct lending kind of strategy, I mean, that is also an expression of a long position. You will get that Bitcoin back. You loan it out at the end of 2021 and you get it back in 2022. Sure, you made, maybe let's call it 10% in interest, but your overall principal when you get that mark to market, especially if you're a public company at the end of 22, did not look so good. So even with the yield and return enhancement kind of strategies, there is very much a relative value component. And look, right now there is a lot to be said for where U.S. dollar rates are. So if you do get a nice increase in price and difficulty remains, relatively lower, like we have been over the last 10 days, it might make some sense to take some gains and maybe park it with a more traditional kind of money manager. You mentioned repos and money market funds. That relative value call is very important here.
So Tyler, like if you're borrowing dollars against Bitcoin, how do you think about counterparty risk?
Yeah, so we are very conservative on counterparty risk. I think we have some veterans. I wasn't there when the ship went down, but I worked at Lehman Brothers and I was at a different bank that did survive in the crisis. Our head of trading has similar kind of background. And so I think the way we've always looked at it is that we're building a business that has a lot of upside optionality. The most obvious one is, we get broad Bitcoin adoption, the price goes through the roof, all that drops to the bottom line, you have great margin expansion in mining. That's obvious. We very actively trade power and manage curtailment. There's a lot of upside optionality to that. The latest thing I think that some folks are doing a lot in, and we're spending a lot of time with these days, is looking at HPC. And so there's all these massive, I think of our company a lot of times as almost like a basket of call options on big trends. And so often, I think when people try to value these companies, they sometimes, if you use like a traditional value metric, you think of it through a value lens and you're backward looking, every company in the space always looks too expensive. And I would argue that's not necessarily the market being frothy or irrational so much as like, you've got a basket of call options on extraordinarily volatile things. And so that option premium is worth a lot. So coming back to answer your question, given that that's our general orientation about our business in general, we believe one or more of these call options will pay off in a big way. We cannot afford to miss out because we have a foot fault and we have a bad counterparty. So the last thing we're going to do is reach on counterparty risk. So tangibly, that means we work with the biggest, most established names you can work with. Maybe someone who's sitting here among and others. But we negotiate like full ISDA standard documents. We're annoying, I think, as a counterparty, probably to those of you that work with us, but that's because like the last thing where we're going to miss is on counterparty risk.
Chris, you have thoughts?
No, I think that's right. I think there's no safe risk-free rate in the space, certainly on a counterparty perspective. I thought Danny and Tyler's perspective on that is the case. And I would say, look, you can only risk yourselves with money you put out there. And if you do, and you want to go get it back, and we used to say, you don't have to meet us in the Bahamas. And that was a joke. Then it was not a joke. And so we'll happily meet someone in a New York court. So we believe how you legally paper is super important. How you, just as you are with how you custody the coins that you mine. And so if you can paper under, what we like to think is U.S. paper or common law, UK. I mean, there's ample legal precedence, and there is a framework that it does not negate your counterparty risk, but at least there's a legal precedence to get what yours back. And so that's how we think about CWA and protecting yourselves. So, and as an extension of that, our team is fully onshore, and we like to, I used to joke, like we used to follow things called the law, and it actually still exists. So and I think that's the only way to get around some of these considerations until the market matures even further.
Great. So obviously, pre my time at Coinbase, there was a pretty dramatic bear market that led to a lot of miners getting burned, a lot of lenders getting burned. What lessons have we learned from that? And I guess, Tyler, why don't we start with you?
Well, I think we were the only loan in the book at BlockFi that fully paid its obligations. So I think the main lesson for anyone out there thinking about lending money is that we're a really good counterparty. I mean, look, it comes back to this same question. I think that this is a really big question for what happens going forward, especially you think about other trends in the industry like HPC versus Bitcoin mining and how this splits. One of the advantages of those more traditional businesses is that they're financeable. So you can borrow money at like reasonable rates. Generally, if you're going to borrow money to build infrastructure in Bitcoin mining, you can certainly borrow against your Bitcoin, but putting that aside, like just getting a construction loan, generally it's pretty vulture-y terms. Like if you're getting the terms, you probably don't want them. And so there's this question about if that will come back. We have a new administration, Bitcoin goes up a lot, every big bank's doing stuff, and maybe we get lending to be more normalized again. But I think, from our seat, look, you've got to be really careful. You're mining an 80, 100 vol asset or whatever. Your stock is even more volatile, and you're 100% equity financed, basically. And folks that took out lots of debt had challenges. I do think convertible bonds are obviously the flavor of the day. You can't swing a cat without finding someone that just ran into a big convert this morning and is trading way down or way up, depending on the day of the week. But again, that's kind of equity-linked financing. So I think, from my perspective, it's trying to run as rock solid a balance sheet as possible because it's just super volatile.
Yeah.
Different from a vendor's perspective.
Yeah.
You guys.
Yeah, from our perspective, we've definitely seen since FTX a lot of new clients coming to us because of the background of our founders, being able to do the due diligence on our company, and also looking into papering very officially. Whether that's with ISDA, also looking into other arrangements at times, such as tri-party, and in general, just trying to make sure that they're doing the right things. And also looking, you've seen the perspective as well, where we've got customers now who might have the perspective of holding the coin versus now being much more on a schedule and really focused on the efficiency of their mining rigs.
Yeah, look, I think it's been mentioned a couple times, there is an inevitable asset liability mismatch if you hold Bitcoin at any time. Doesn't mean it's not a good idea, but you are incurring US dollar expenses at a minimum in power. You are generating Bitcoin. You're not realizing a US dollar revenue stream until you've actually done something with that. So look, it is pretty obvious, but you got a capital stack, you got operating expenses. If you're holding something on balance sheet that is decreasing in value as your revenue is also decreasing in value, you have a shot clock. There is a finite amount of time there. And again, not everyone, we're pretty fortunate with Core to be able to make a comeback through that. That is extremely rare. Stay on top of it.
Chris?
I think this panel has been very balanced in terms of how realistic Bitcoin mining and managing its treasury is, but I think there's a more positive spin to it also, and I don't mind, so I'm just going to talk about it. But excess return really is about, what is the distribution, what is the call options that both Danny and Tyler are working on within their companies, and how does that overlap with actually what the market gives you? And for the traders in the room that got into the space, we've never seen a forward distribution like this in our careers, and I am old. I don't look old, I am old, and I feel older. I've never seen this in my life. I've seen this twice in Chinese stocks and gold and oil and the peak of 2008, and I've never seen this ever again, except it's persistent in Bitcoin. And so when you think about the optionalities that these businesses are growing, there is actually a growing and liquid market to manage that treasury with positive expected value. And that's the upside. There's multiple different tools in the toolkit for treasurers these days. And as the market matures, that's the best part of it all, is really kind of weaponizing the arsenal of these corporates and giving them as much of a chance to monetize these embedded call options of their companies. And that's what we think. We try to put ourselves in that position and think through all the tools in the toolkit. But that is the upside. And I'd say, I'm happy to discuss that further, but I'm sure Ari has opinions on this. But it's just this options market and these forward markets are super, super fascinating. It gives corporates like this some fascinating tools.
All right.
Hash rate as well. Yeah.
And hash rate futures as well, yeah.
Yeah, I think that's exactly right. Having been in what might seem like a related business, which is trading gold options, this may seem, it seems this is digital gold. No, this is digital gold at like 10x the vol, and it is provides for incredible opportunities because it is not quite a fully, it's not that S&P 500. And so that affords a corporate like the miners to be able to take advantage of the fact that it's not a mature space. People don't know exactly what the distribution ought to be, that there's mismatches in demand, and that there are structures that can be put in place to both allow you to keep the upside and also protect on the downside.
Along the lines of the evolution here in terms of the recent election, when do we expect to see traditional banks, like some of the banks that we all worked for, come into this market as a lender or as a tool provider to the Treasury management? Chris, since you just left a big bank.
I hope never. No, they will. They are. I think there's a couple things, and I don't even know if it's a consideration around, and I'm not a lawyer, but I don't even know if it's a consideration around their interest in the space. I think it's more around they got 99 problems every day. I don't know if they want to add another. And I don't mean that in a negative way. The considerations of putting an asset on a balance sheet of a bank is all the governance around that, and then Basel, risk-weighted assets and capitalizing that. This is not a level 3 asset because of the transparency, but this is going to be a highly punitive capital asset class, just like electricity already is for them. So from that perspective, maybe the ETF solves some of that considerations, but for the physical Bitcoin players, I don't know. I don't think it's about interest. I think it's about just feasibility and is that the best return on shareholder equity for them. And then the reporting, and then the I've been in governance meetings with OCC, DOJ, SEC. It's so much fun, right? And then they're going to highlight the 0.002% of Bitcoin you have in your balance sheet, and you're going to spend the whole day talking about that versus the real problem that you might have in your CNI book. So they're absolutely coming in. I think more is more. It makes the space more liquid, more viable, but it's just going to take some time.
So just to keep it fun, I'll take the other side of that. I'll say I think it will happen faster than probably we expect. And the reason for that is that, again, exactly to Chris's point, historically it was sort of like, well, what's the opportunity here? Well, there's some niche, smaller, again, take a giant, I'll pick on Goldman. I worked at Goldman. So they're looking at the opportunity in the space, and it's like, oh, we could make tens of millions of dollars launching into this new area. And to Chris's point, and every regulator on earth is going to be all over us and annoying, and there's going to be tons of work. Why don't we hire 5 more high yield traders and make the same amount of money? I think the difference here is it is a big deal, I think, to have this red wave coming to power where it's just making everything feel much safer to be a little more adventurous. And so, the sort of non-specific, yes, it may take a year to get a crypto market bill or something like that actually passed, but I think the general attitude around it may lead people to try to almost switch their positioning to be like, oh, we want to be ahead of this curve now rather than being dragged into it.
And you noticed Goldman is spinning off their digital, which is a much easier way for them to deal with those issues you described. If they spin it out and then buy it back or whatever they
Provide
need to do.
capital or something.
Yeah.
I think to Tyler's point, what we have seen is foreign banks already try to come into the US to bank the space. And that's a sign that if other jurisdictions were already feeling better about it before the red wave, then everyone's going to come in. I don't disagree with that thesis.
My clock is telling me I got 1 second, so I want to thank the panelists. It was fantastic. Appreciate it.